So we're here with Andrew Sheiner, coming down from Toronto. Andrew, thanks for being here.
Thank you. Nice to be here.
So, as we know, Andrew, the private equity industry as a whole has undergone enormous change over the last decade in particular. I guess just, to start things, in your view, how is the industry evolving today, in your opinion?
So, like a lot of mature industries, private equity is fragmenting, segmenting, but also becoming more discerning. And what you see is the emergence of long-dated funds and permanent capital funds and secondary groups with lots of different strategies. So investors around the world are finding different ways to access the private equity industry. But for traditional private equity investors, and there are some 400 in North America alone that manage 500 million of capital or more. It's a very, very large industry. Not surprisingly, what they're finding is that investors globally are becoming very discerning, and the successful firms are attracting a lot of capital, and the middling performers are finding it challenging appropriately.
And can you talk a bit about how you've kind of positioned us within this kind of evolving ecosystem over the last decade or so?
Sure. Yeah. Our firm was founded in 2012, and we understood when we established the firm that we're operating in an era where the industry is mature and competitive, intensely crowded. And so the question for us was, how can we establish a firm that has a chance of doing well and generating good returns over the next 20 or 30 years? Because fundamentally our objective, our overarching objective as an investor of capital, is to generate attractive private equity returns with the least amount of risk over a long period of time. And the strategy that we set out to pursue really had that objective in mind, and it's a very particular strategy, which is first and foremost to be very discerning as an investor. And what that means for us is to look at 200 to 300 opportunities each year to only find one or two that we think are compelling. So we've built our portfolio in a very measured way to focus on very high quality businesses, but ones that have a line of sight and that we think we can grow to the next level. And then to have a flexible time horizon and to enjoy sort of the optionality of ownership, understanding that most businesses that we buy will likely own for 4, 5, or 6 years. But if we're fortunate, we'll find, hopefully, the occasional business we can take to the next level over a longer period of time and generate not only great IRRs, but terrific multiples of capital. So it's a very unusual strategy. I mean, we've bought now 7 businesses in 7 years. We've invested about $3.3 billion of capital, and we've compounded our capital at close to 40% from a rate of return standpoint. And I think being very disciplined and measured in our approach has contributed to that.
Sounds like a very selective process throughout the journey.
It is, yeah.
Now, I know your firm is based in Toronto.
Yes.
But only, one other economic recovery in the United States, I believe it was 1991 to 2001, has extended as long as the current expansion.
Yes.
So where do you feel we are in the cycle right now?
It's an important question, yeah, and I always joke, we've been operating as if we're at the end of this economic cycle for the past 6 years, right? It's obviously hard to know, and as everybody says, we're nearer the end than we are the beginning. I think the key question is how you conduct yourself, knowing that we're somewhere near the late stages of a cycle. And for us, it has a few components. More than ever, we're trying to focus on high-quality businesses that we think can withstand downturns. But because of the high prices being paid in the market, those need to be businesses where there's a clear perspective on how we can grow them. And for the last many years, we've been really focused on trying to acquire businesses that don't have huge sensitivity to economic cycles. Of the 7 businesses that we bought, one definitely does, but it's a business that has the ability to pursue tuck-in acquisitions at 2, 3, 4 times cash flow. So we think we can go through a downturn. But the other of our businesses, and businesses like road salt distributors, right, which doesn't really rely on the economic cycle, it relies on weather. right? Or it's dependent on the
which
weather.
you have in Toronto.
We have lots of weather up in Canada. We own the largest international medical school in the world, and what determines whether kids want to go to medical school really isn't the economic cycle. So that has been an important factor for us in our ongoing effort of trying to find interesting businesses to acquire.
Now, how has kind of the reduction in interest rates over the past decade or so really impacted the industry?
In a very meaningful way, right? If you go back 170 years, the 10-year Treasury, because in investing everything follows the 10-year, has toggled between 3 or 4% and 7 or 8% in that entire period, but for 3 10-year periods, right? The 30s, early 80s when rates were very high, and the last decade. And what happens when rates fall as they have is cap rates reduce, multiples increase, and that's a hugely important factor when you buy a business and underwrite it, because rates can't go lower than they are. So that era is now behind us. And I think it's important to understand how a business will perform if rates rise and multiples fall as a result. It goes to how you finance the businesses, but much more importantly, it really relates to the economic outlook for industries and companies as a result.
I guess kind of as a follow-up question to that, so I think recently JP Morgan cut its year-end outlook for yields and interest rates.
Yes.
Predicting the Fed will ultimately cut rates in the second half of this year. So what might a new round of cuts mean specifically for the private equity industry?
That's more, in many respects, more relevant for bond investors, high yield investors, leveraged loan investors, and in a sense public market investors than it is for private equity investors, because where rates are at a point in time are critically important simply when you buy a business. And so lower rates are obviously helpful from that standpoint. I think the more interesting question is what that portends, if anything, for the economic cycle over the next 2, 3, 4, 5 years. And we're clearly entering a period where growth in employment is starting to reduce a little bit. The amount that companies are investing is reducing. We have trade tension in a way that we haven't had for a very long time that ultimately is going to start to trickle through. And with the abatement of the stimulus that came from tax reform, I think we're reverting now to a slower growth economy of 1 or 2%, which is fine for private equity. When things become tricky is when something happens, something precipitates the next recession, and you never quite know what that's going to be, and growth goes negative for a few quarters. The further you get away from the last downturn, the more people forget what that means and how hard it is to manage through that with operating companies. At the end of the day, it's what we do, right? We own companies, and we have to navigate cycles and find ways to do well regardless of what the environment is.
And I guess finally now, we're at Super Return. One of the big topics, obviously, especially among private equity and your competitors, is value creation, right?
Yep.
How do you differentiate yourself? So what do you think are among the most effective ways for private equity managers to really, truly create that value?
So it's so important, right? Because the era of creating value in terms of returns through a reduction in rates and growth in multiple is for sure behind us. And the only way you're going to truly generate returns that are sustainable and reliable and safe, right? Because financial engineering isn't safe, is by being able to add value as an engaged owner of businesses. And everybody has their own approach to that. For us, we were 3 co-founders that started our firm. One of them came from an operating background. So he had spent part of his career in investing, and then was a senior executive helping to transform the global cost structure of a big global business. And that informs how we think about what we do. And for us, it starts with talent, and then it goes well beyond that. And what we try to do with each company every year is identify what are the 3 or 4 key strategic initiatives and operational initiatives that are going to be essential to execute on a plan to take that business to the next level, and then to bring resources to each business that are different, because every circumstance is different, both internal and external, right? The best data analytics group, the best AI group, the best supply chain optimization group, together with the capabilities that we have, because we have an orientation as a very engaged owner and experience in that with our team, to really help our management teams take their businesses to the next level. Because at the end of the day, our job is to provide support, resources, and capital to the management teams that we have, and to make sure, first and foremost, that we have the absolute best CEO, that we align on a vision with them, and then collectively can structure a partnership to take each business to the next level each year based on what the objectives are.
Great. Well, Andrew, thank you very much for joining us today.
Real
It's
pleasure.
been a pleasure.
Thank you.